Hello students, myself N.K. Thukral from Edupedia World. Students, if you remember last time in the last session I had discussed on subject insurance, principle of insurance, functions of insurance and types of insurances. So one of the type of insurance is life insurance. I will discuss today on life insurance. Students, let me brief you. Since life is very precious and any unexpected thing can happen, everyone tries to insure themselves. There are every chances for all the individuals to experience something accidental, including death. If that's the case, then there will be no one to take care of other members of the family if they are dependent on the person. The other risk is that the person may live too long that until he becomes old enough to retire, the earnings are going to decrease and even in the later. Hence, to overcome such difficulties, such problems, people seek help from the insurance companies. To overcome the uncertainty of life, life insurance policy was introduced. But as time went on, many other insurance policies have come under way according to the individual needs. Life insurance is defined as a bond in which the insurer, in consideration of a certain premium, either in a lump sum or by other periodical payment, agrees to pay to the assured or to the person for whose benefit the policy is taken. So this is what the background of life insurance. Now students, let's see what is life insurance. What exactly is life insurance? Life insurance contract is a contract under which the insurer agrees to pay a specified amount on the death of the assured or on the expiry of a certain fixed period, whichever is earlier. So there are two issues involved in this life insurance policy. Number one is insurer agrees to pay a specified amount that too on the death of the assured, or if he survives, on the expiry of a certain fixed period, whichever is earlier, either of these two, whichever is earlier. So this agreement or contract, which contains all the terms and conditions, is put in writing, and such document is called the policy. So what is life insurance policy? This is a type sort of agreement or a contract between the insurance company and the insured, which contains all the terms and conditions, and they all are put in writing so that there cannot be any issue later. The person whose life is insured is called the assured. The insurance company is the insurer, and the consideration paid by the assured is the premium. Under the contract, the sum assured is paid to the assured if the policy matures during his lifetime or to the nominees of the assured in case of his death. The premium has to be regularly paid to the insurer by the insured, which may be annual, half-yearly, quarterly or monthly. That needs to be decided by the assured. What is his capacity? So life insurance policy was initially introduced to provide protection against the uncertainty of life. However, its scope has widened and there are various types of insurance policies as per requirements of an individual. For example, disability insurance protects the income of a disabled person. Health insurance covers the cost of medical expenses. Annuity insurance offers pension so long as the person is alive. So these are the kind of further policies under life insurance policy. Now students, let's see what are the essential elements of life insurance. Number one is essentials of a valid contract. Elements like existence of an agreement, free consent of the parties to that agreement, competence of the parties to contract, and lawful consideration are necessary for a life insurance contract. The bond or the agreement is supposed to have all the essentials of valid contract. Certain things like offer and acceptance, free consent, capacity to enter into a bond, lawful consent, and lawful object must be there for the bond or contract to be valid. Another essential element is utmost good faith. What is this? The assured has to be true and honest in giving information to the insurance company, as it is a bond of utmost good faith. He should give all the necessary facts to the company accurately. The assured must disclose all the material facts. Again, I am repeating material facts about his health to the insurer, even if the insurer does not ask him he should be honest and truthful. Otherwise, later on, at the time of getting compensation, the difficulties may arise. So, utmost good faith is one of the prime essential elements of life insurance policy. Another is insurable contract. What is this insurable contract? Under insurable contract, insurable interest is there. The insured must have insurable interest at the time of making the contract. Without the insurable interest, the contract is void. However, presence of insurable interest is not necessary at the time of maturity. Under this, the insured must have some interest in the life insurance policy. Without any interest, the bond is void. Another one is not a contract of indemnity. This contract or life insurance contract is not a bond of indemnity. Mind it, it is not a bond of indemnity. The life of the insured cannot be brought back, but only some amount of money can be reimbursed, and that is why the amount is decided well in advance. The amount reimbursed is fixed earlier to the signing of the bond, hence it is not a bond of indemnity. So students, after having known about the life insurance policy and essential elements of life insurance, let's go ahead and see what are the types of life insurance policies. As you can see in the slide, number one is whole life policy. What is whole life policy? But before discussing on one by one, let me tell you, the paperwork containing the terms and conditions along with the signature is called the policy. That you need to know. The paperwork containing the term and conditions along with the signatures is called the policy. The policy is issued after the proposer and the insurer fill in the proposal forms. Requirements differ from person to person according to their needs. They can be family needs, children need, old age, or special needs. To cater the needs of everyone, the insurer have developed different types of schemes such as whole life insurance, endowment type plans, combination of whole life, endowment type plans, children insurance policy, etc. etc. So, let us discuss on one by one. Number one is whole life policy. In this kind of policy, the sum insured is payable only on the death of the assured to the beneficiaries or heir of the deceased. The premium is payable for a fixed period. You can say it 20 crore or 20 or 30 years, or for the whole life of the assured. If the premium is payable for a fixed period, the policy will continue till the death of assured. Another second type of life insurance policy is endowment life assurance policy. Under this type of policy, the insurer undertakes to pay assured a specified sum on the attainment of a particular age or on his death, whichever is earlier. So you need to understand these 2 points. On the attainment of a particular age or on his death, whichever is earlier. In case of death of the assured, before he attains the specified age, the sum is payable to his legal heir or the nominee. Otherwise, the sum is paid to the assured when he attains a particular age and alive. Thus, the endowment policy matures after a limited number of years. Another one is joint life policy. This policy is taken up jointly on the lives of 2 or more persons. On the death of any one person, the assured sum or policy money is paid to the other survivor or survivors. The premium is paid jointly or by either of them in installments or lump sum. Usually this policy is taken up by husband and wife jointly or by 2 partners in a partnership form where the amount is payable to the survivor on the death of either of the 2. Another one is annuity policy. What is this policy? In this policy, the assured amount of money is paid after the assured attains the mentioned age in monthly, quarterly, half-yearly or annual installments. The premium is also paid in installments or as a whole. This policy is useful to those who want to have regular income after attaining a specific or certain age. Another is children's endowment policy. This policy is useful to those who want to manage the education or marriage of their children in the future. The insurer pays the assured a certain amount of money after the children attain certain age. The person entering into a bond pays the premium, but no premium will be paid if he dies before the policy matures. So these are the types of insurance policies nowadays at present available. Now students, you must need to understand what is insurance and what is assurance. Insurance, I-N-S-U-R-A-N-C-E versus assurance, A-S-S-U-R-A-N-C-E. There is a difference. Let us understand that. What is insurance and what is assurance? Insurance refers to granting of agreed compensatory payments on the happening of certain events specified in the contract, whereas assurance is applied to those contracts which guarantee the payments of a certain sum of money to the insured on the happening of a specified event. Under assurance, the event is bound to happen sooner or later, like death. The word assurance is used when the life of a person is insured. Life insurance policy is a contract of assurance as payment of compensation is assured by the insurance company. And insurance, the events specified in the contract are uncertain. That is, event may happen or it may not happen. Fire and marine insurance policies or contract of insurance as compensation in such policy is paid only when the event specified in the contract occurs. Under fire, like for example, under fire insurance policy, if fire occurs, only then the compensation is paid. Otherwise, it is not an assurance, not fixed amount. Only on the happening of the event, this insurance is called as an insurance. So these are the differences between insurance versus assurance. So students, I think you have understood fully life insurance policy. And let's go ahead and see what is health insurance. Let us understand what is health insurance policy. Health insurance policy is a contract between an insurer and an individual or a group in which the insurer agrees to provide specified health insurance at an agreed premium, or you can say agreed price. What are the reasons for origination? How it originated? In mid-80s, most of the hospitals in India were government owned and treatment was free of cost. With the advent of private medical care, the need for health insurance was felt and various insurance companies introduced health insurance as a product. This is how it was originated. Nature of protection. Under health insurance is taken as a safeguard against rising medical cost. Students, you know, every day inflation is there, every year inflation is there, and medical cost bound to rise. So health insurance is taken as a safeguard against rising medical costs. It provides risk coverage against unforeseen health expenditure that may result in the financial hardship. Another element of health insurance is premium. Depending upon the policy, the premium may be payable either in a lump sum or in installment as agreed between the insurer and insured. Another element is type of health insurance. There are mainly three types of health insurance covers: individual mediclaim, family floater policy, unit-linked health plans. What is individual mediclaim? It covers the hospitalization expenses for an individual for up to the sum assured limit. And family floater policy, it covers the hospitalization expenses for the entire family up to the sum assured limit. So under both these things, assured limit is there. Within that limit, this insurance is covered. Unit-linked health plans, this policy combines health insurance with investment and pays back an amount at the end of the insurance term. This is what that type of health insurance policy is. Another element is claim settlement. Now there are two ways by which health insurance claims are settled. Number one is cashless. Number two is reimbursement. Cashless means the claim amount needs to be approved by TPA and the hospital settles the amount with the TPA or third party administrator, you can say, is a middleman between insurer and the customer. And under reimbursement, the insured avails the treatment and settles the hospital bill directly at the hospital. The insured can claim reimbursement later on by submitting relevant bills, documents for the claimed amount to the third party administrator. So these are the element of health insurance. So we have covered today life insurance policy and health insurance. So that's all for the today. Thank you. Bye bye.